Welcome back to GE Fun Facts Online. Today we are diving deep into what is arguably the most critical yet least understood component of the global future. We are going to talk about money, specifically the financing of the energy transition. For decades, the narrative has been about technology. We asked, can solar panels get efficient enough? Can wind turbines get big enough? Can batteries last long enough? As we stand here in early 2026, those questions have largely been answered. The answer is yes. We have the solar panels to harvest the sun, the turbines to catch the wind, and the electrolyzers to split water. The technology is ready. But the transition is stalling. It is no longer a question of engineering physics. It is a question of financial physics. We are facing a paradox of historic proportions. On the surface, the numbers look incredible. Global investment in energy has surged to a record $3.3 trillion. Clean technologies are now attracting $2 for every single dollar spent on fossil fuels. Solar power has historically become the cheapest source of electricity, attracting more capital than all upstream oil production combined. We have officially entered the age of electricity, driven by the relentless electrification of transport, heating, and the massive power demands of artificial intelligence data centers. Yet, beneath this veneer of progress lies a profound and widening chasm known as the green capital gap. This is not just a shortfall in accounting. It is a structural failure of the global financial system to allocate resources where they are most needed. While the global north and China race ahead, capitalizing on deep financial markets and massive government subsidies, the global south is being left behind. The gap between the $2 trillion we are currently spending on clean energy and the $5 trillion required annually to stay on a 1.5 degrees Celsius pathway is measured not just in currency, but in future stranded assets, geopolitical instability, and accelerated climate catastrophe. To understand how to fix this, we have to look at the anatomy of this gap. The issue is distribution. If you are a developer building a solar farm in Texas or a wind park in the North Sea, capital is abundant. In fact, there is often too much capital chasing too few bankable projects in the OECD, which compresses returns. Conversely, if you are trying to build that exact same solar farm in Nigeria, Pakistan, or Indonesia, capital is either non-existent or prohibitively expensive. This creates a vicious cycle known as the capital cost trap. The cost of capital, which is essentially the return investors demand to lend money, can be up to 7 times higher in emerging markets than in advanced economies. A project that is profitable with a 4% interest rate in Germany becomes a financial disaster with a 15% interest rate in Kenya. This trap is the single greatest barrier to the global energy transition. It creates a two-speed world. In the fast lane, you have the advanced economies and China. China accounts for nearly a third of global green investment, using state-directed capitalism to deploy renewables at a staggering pace. The United States, propelled by the Inflation Reduction Act, and the European Union with its Green Deal, have created robust markets where tax credits de-risk investment. But in the slow lane is the global south. Despite holding 60% of the world's best solar resources, Africa attracts less than 3% of global clean energy investment. This isn't because there is no demand. 600 million people there lack electricity. It is due to the perception of risk. International investors cite political risk, currency risk, and regulatory instability. While real, these risks are often overstated by Western credit rating agencies. This leads to the sovereign ceiling problem. A private solar company in a developing nation cannot be rated higher than the government of that country. If the country has a junk credit rating, the solar project is deemed junk, regardless of its individual economics. Compounding this is the debt crisis. Many emerging economies are drowning in debt service payments, spending 40% of their revenue paying off external loans. They have no fiscal space to offer the sovereign guarantees that international developers require to secure financing. This divergence threatens to fracture the global economy because carbon dioxide does not respect borders. If the global north decarbonizes while the global south is forced to burn coal to develop, we all fail. Beyond the geography of money, we have a sector problem. We are seeing a green asset bubble in mature technologies like solar and EVs, while hard-to-abate sectors like steel, cement, shipping, and aviation are starved of finance. These industries account for nearly 30% of global emissions, but require massive upfront capital for technologies that aren't yet fully mature, like green hydrogen or carbon capture. Investors, driven by quarterly returns, shy away from the technological execution risks here. This creates a chicken and egg problem. A green hydrogen developer cannot secure billions in debt financing without a long-term contract from a buyer. A steelmaker won't sign that contract unless they know a car manufacturer will buy their expensive green steel. And the car manufacturer waits for the consumer. Breaking this deadlock requires transition finance. This is a controversial but necessary evolution, where we fund dirty sectors provided they are on a credible path to decarbonization. However, fears of greenwashing accusations keep much of this capital on the sidelines. Now, let's look at the infrastructure itself. We are entering the age of electricity, where demand is decoupling from economic growth due to EVs, heat pumps, and the explosive growth of AI. In some regions, AI data centers alone are projected to double regional power demand by 2030. This surge is crashing into a grid built for the 20th century. Financing generation is easy. Financing the grid is hard. A transmission line is a linear project crossing hundreds of miles of private property and multiple jurisdictions. It faces immense permitting hurdles. In the developing world, utilities are often technically insolvent, losing money on every kilowatt hour due to theft and old wires. Investors won't pour money into generation if the grid utility, which is their primary customer, cannot pay its bills. We also face a storage gap. While lithium-ion batteries are solving short-duration storage, we lack the long-duration energy storage needed to cover weeks of low wind and sun. Technologies like pumped hydro or flow batteries are capital-intensive and lack the market mechanisms to reward the insurance value they provide. So, what is the solution? How do we engineer our way out of this financial deadlock? We need to open the financial toolbox. First, there is blended finance. This is the strategic use of public or philanthropic funds to mobilize private capital. The logic is that a public institution, like the World Bank, takes the first loss position. If a project goes bust, the public money is lost first, protecting the private investor. This improves the risk-return profile, making unbankable projects bankable. However, this has been too slow and bespoke. We need to move from artisanal blended finance to industrial scale, using standardized portfolio guarantees. Second, we have the explosion of green bonds and sustainability-linked bonds. Unlike traditional green bonds, ring-fenced for specific projects, sustainability-linked bonds tie the interest rate to the company's performance against climate targets. If a company misses its carbon reduction goal, its interest rate goes up. This directly aligns the chief financial officer's incentives with the planet's health. Third, we have carbon markets 2.0. After years of scandal and volatility, high-integrity carbon markets are emerging under Article 6 of the Paris Agreement. This allows countries that over-deliver on targets to sell credits to those lagging behind. It also allows corporations to funnel money into the global south for forest protection or clean cookstoves, providing a vital revenue stream for projects that otherwise offer no financial return. Fourth, we are seeing the rise of green banks. These are public entities like the U.S. Greenhouse Gas Reduction Fund, designed specifically to crowd in private capital at a ratio of 7-to-1. They understand local risks better than Wall Street and can offer the concessional loans needed to kickstart markets. To make this work, we also need to address the specific mechanics of bankability in emerging markets. We face the off-taker risk I mentioned, where the buyer is broke. Solutions like the World Bank's MIGA provide insurance, but we need platforms like Africa Green Co., which acts as a creditworthy intermediary to buy power. We also face currency mismatch. Projects earn local currency but pay back debt in dollars. If the local currency crashes, the project dies. Funds like the Currency Exchange Fund, or TCX, offer hedging, but the real solution is developing deep local capital markets so projects can be funded in their own currency. Then there is the geopolitical overlay. Money does not exist in a vacuum. The U.S. Inflation Reduction Act changed the gravity of global capital, sucking investment to the U.S. The EU responded with the Net Zero Industry Act. While this competition accelerates deployment, it risks fragmenting the global market through friendshoring. We also have the critical mineral security issue. The transition needs copper, lithium, and cobalt. Western investors are hesitant to fund mines in difficult jurisdictions due to ESG concerns, leaving the door open for Chinese state-backed entities to dominate the supply chain. If we restrict trade in the name of security, the cost of the transition rises and the capital gap widens. Finally, we must not forget adaptation. Almost all this money is for mitigation, reducing emissions. But the Global South needs trillions for adaptation, like seawalls and drought-resistant agriculture. These projects generate no cash flow, so private finance ignores them. We need innovative mechanisms like resilience bonds or debt-for-nature swaps, where a country's debt is forgiven in exchange for investing in conservation, as Ecuador recently did for the Galapagos. The green capital gap is not just a statistic. It is a measure of our inability to align economic systems with physical reality. Closing it requires multilateral development banks to take more risk. It requires policymakers to provide certainty. It requires central banks to recognize climate stability as a prerequisite for price stability. And it requires private capital to look beyond the quarter. The cost of closing the gap is $5 or $6 trillion a year. But the cost of not closing it is incalculable. It is the cost of lost cities and collapsed food systems. The money exists. The world has never been wealthier. Bridging this gap is the defining challenge of our time. The bridge is being built, dollar by dollar, innovation by innovation. The only question remaining is whether we will finish it in time.